Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax planning topics. I'm Ben Willis, contributing editor with Tax Notes. Today, we'll be discussing Section 199's pass-through deduction, as highlighted by recent proposals with respect to the corporate tax rate and capital gains rate and changes to them. I'm joined by Jed Bodger, who I met over 12 years ago while interviewing at PwC's national office. We became great friends then and have continued that relationship since. At that time, he joined the International Tax Services Group at PwC, and I joined the Mergers and Acquisitions Group, but we continued to work closely together. After leaving PwC, he became the Deputy Attorney General for the state of Nevada. And after an extremely successful career, is now the Vice President of Tax at Sierra Nevada Corporation, an aerospace and defense contractor with international operations. Thank you so much for joining us today. How are you doing, Jed?
Ben, I am fantastic. Thank you so much for having me. It's been 12 of the greatest years to have you as both an accomplice and a friend. So I look forward to many, many more. How are you today?
I'm doing good. A little nervous about the word accomplice there, given your notorious activities. No, I appreciate that. I feel the same, and glad to be continuing our countless tax discussions that we've been having over the course of 12 years. So really, really good to dive in. And before we jump into 199, Section 199A, which provides this pass-through deduction, which you and I have talked about a lot recently since we worked on an article on the topic, especially in light of the recent Biden-Harris tax proposals that have been of interest as of late. I just wanted to give a high-level overview of my personal views with respect to tax policy, because I think it's really important to lay the foundation when we're talking about tax reform, particularly since both Senator Kamala Harris and former Vice President Joe Biden have said that they'd like to change or eliminate parts or all of the Tax Cuts and Jobs Act. And so with that said, with the larger tax reform discussion in hand, I think it's really important to just let folks know that when you're discussing tax reform, some of the fundamentals, the foundations, the principles underlying tax reform and legislation are intended to be, or the goals, which may seem lofty to some, but not others, are transparency and fairness. And that fairness component is a large part of the discussion that we're going to have today. I'd also like to say simplicity is a goal of tax reform, but that's a pretty lofty goal. And when I go back and I look at some of the largest pieces of legislation, 86 even, which had a fantastic bipartisan support before it, was extremely complicated, and while there certainly was some simplification for sure, there's always some difficulty in conveying tax topics and capturing them in the Internal Revenue Code. And I think the reason for that is just the sophistication of tax out there, which has only increased over time with technology and some of the interesting topics like cryptocurrency and other international apportionment issues and whatnot. With that said, Jed, could you give us a little bit of a description of Section 199A?
Absolutely, Ben, I'd be happy to. I mean, to your point with regard to tax reform, you're exactly right. Simplicity is frequently a driver, and 199A misses the mark there because the actual computation for 199A is a series of just sort of continual steps that, depending on whether or not you're in a specified service business, loop back onto themselves, the old snake eating its tail type of a situation. And then when it comes to fairness, it also doesn't necessarily make that, because what it does is it creates disparity and it creates different rate pools for different types of businesses. So on a broad scale, Section 199A is a tax deduction for pass-through entities like partnerships, LLCs, and S corporations. And it is available for qualified trades and businesses. uh, the broadest, what Section 199A does is provide a 20% deduction for qualified business income, which reduces the overall effective rate for members or partners of these pass-through entities from the stated marginal tax rate of 37% down to kind of an effective rate right around 29.6%. Now, qualified trader business in and of itself is defined via exclusion. So only certain pass-throughs are able to take advantage of the 199A deduction. Specific service trades or businesses are eliminated, right? And these are eliminated based on the type of business that they perform, as evidenced within the code. And for the most part, these attack professional services, law, accounting, financial services, medical services. Those are exempted out from the beneficial application of 199A, which effectively creates two different types of pass-through entities. One that is qualified for 199A deduction purposes and one that's not. I mean, I don't know, Ben, what do you think? That feels a little discriminatory to me.
I agree with you. Absolutely. We talked about my views on fairness with respect to tax reform policy and parity, which has been improved by the check the box regulations. But now we look at Section 199 and we see that they've really divided the country with respect to businesses that qualify and don't for this special pass-through deduction. And healthcare businesses, for example, don't, whereas real estate businesses do. And in fact, Treasury even promulgated Rev Proc 2019-38, which gives a safe harbor for real estate businesses. And the regulations have largely been generous, in my opinion, with respect to these types of businesses and these deductions. But it's interesting. America has changed greatly, and I don't expect that change to occur with respect to the types of businesses that we're engaged in, what our economy is focused on. Historically, we were engaged in manufacturing, and perhaps many would like to return to that, but now we are a service-based economy. So by Section 199 excluding so many service industries from the 199A deduction, they're really preventing our economy from continuing its path and the way that the trajectory that our economy has been heading. And perhaps that's intended to subsidize manufacturing businesses, but I think in actuality, the way that it's playing out is it's creating, for one, discrimination, and two, gamesmanship. So people can squeeze into the 199A pass-through deduction to take advantage of its rate. I guess in order to really fully appreciate that question about the fairness of Section 199A, we have to understand a little bit more about its underlying purpose. So, Jed, would you share your views on your understanding of the purpose of Code Section 199A?
Absolutely. I actually think this is relatively clear in so far as the Congress had a purpose in mind. They had it clearly within their sights, and they were unable to execute to the vision. If you read the legislative history, the purpose is to create tax rate parity between differently situated types of entities. It was really an attempt to eliminate, just like you say, gamesmanship in the type of entity or entity choice between entities, right? Ultimately, the intention was to bring the end-to-end tax from corporations, that double tax, into alignment with the effective tax rate for single taxation entities such as pass-throughs. And they did that. They did that via rate differentials, right? Reducing the corporate rate to 21% and the individual top marginal rate to 37% creates exact parity on an end-to-end basis when you compare the double layer tax to the single layer tax. And then they added this unnecessarily. So it's not entirely clear. Their stated purpose, I think, is parity. The application of 199A destroys that, unless, that is, you think that parity is to go back to the rate preference that partnerships had. That seems to be against the plain reading of the legislative history from my perspective. but I mean, Ben, you're deep into the Biden-Harris proposals. You were there for a lot of the discussions in 2017 under the TCJA. I mean, when they're talking parity in the legislative history, are they really actually talking about getting back into a rate preferential parity, or are they actually talking about getting to some sort of equality between entities to avoid this choice of entity gamesmanship?
That's a great question. And in fact, there are statements out there made by Congress, uh, men and women who have stated that the goal was to return to the parity that existed, or again, quotes, air quotes, parity that existed prior to TCJA, which gave pass-throughs a nearly 10% rate benefit. And that's not what the legislative history shows at all. And in fact, the fact that we're excluding so many businesses from the 199A benefits, if you take a look at it as a whole and you just compare without 199A, the 21% rate and the individual rate under the Tax Cuts and Jobs Act, you're looking at parity, which was and with the stated goal based on the legislative history. And so it's only these subsidized industries that qualify for this Section 199A deduction that are really benefiting and causing distortions, and again, with questionable goals as to whether or not those businesses are indeed, what was the purpose of ensuring that architects and engineers, benefited, but ensuring those in the medical profession don't, notwithstanding that there are real estate moguls who are making millions and many who would qualify for this pass-through deduction, but others who are on the front lines of the coronavirus aren't. And the coronavirus, one of the reasons that we're speaking on this in this means is largely important for what the proposals are by former Vice President Joe Biden and Senator Kamala Harris, which is to try to make a comeback from the current situation, which is the fact that we're down nearly 30 million jobs, and their plans relating to infrastructure and their goals to create clean energy resources to try to bring back jobs is one that has historically been utilized to do that, to recover from recessions, to create government spending. But how do you create government spending when your deficit is at an all-time high and it's growing every day because of a pandemic that is just devastating the healthcare industry, the health of our workers, and the budgets of our states and of our nation. And so obviously, with respect to that, those expenses, there's going to have to be some offsets. We're going to have to collect taxes, and we can't simply continue to reduce taxes as some would hope for. It's just not happening. People don't have the money to spend to reinvest to accomplish what the goals are that some are suggesting would be achieved if this was done. And so now we have these Biden-Harris proposals that would increase the corporate tax rate to at least 28%, which is, it was historically before the TCJA 35%. They brought it down 14% to 21, and this would be bringing it back up 7 points, or halfway, 50% increase from the decrease that occurred. And then you couple that with their proposal for the capital gains increase, and you have a big increase on taxes that largely hit the wealthy, which I don't think either has tried to hide the fact that they're really aiming for a progressive tax rate structure in which those at the higher income brackets would be hit hardest. And there are other proposals that we can talk about down the road related related to payroll and perhaps some foreign points that'll be very interesting in that regard. But just with respect to these two changes, the corporate rate increase and then the capital gain, you've actually eliminated a massive disparity in the code that there are so many provisions that are designed to prevent and abuses related to. The shifting of capital gain to ordinary income to capital gain has just been immense. And in fact, it was one of Trump's promises to eliminate the carried interest loophole, which private equity fund managers were using to do just that, convert ordinary income rates, which would be 37% to 20% capital gain rates. And this would actually accomplish that goal, as opposed to just extending the holding period as 1061 currently does. Those are the key changes on the table. What I'll put back to you, Jed, is how does that play out with respect to the 199A deduction, the change of the corporate and rates and the capital gain rates?
So the maintenance of 199A continues the disparity in either a Biden-Harris tax code or a TCJA tax code. If the rate changes that the Biden-Harris plan suggests are implemented, you could actually see those disparities grow and get significantly out of whack. At current capital gains rates, with a 28% corporate tax and a 39.6% marginal income tax rate at the highest end, you end up with an end-to-end effective rate for corporations at about 42.4%. That's for both layers of tax. However, with pass-through, you end up with an effective rate with the 199A deduction of about 31.7%. That's about a 10% rate disparity between the two, which, to your point, goes back to the rate preference that you saw prior to TCJA for pass-through entities. Now, if you change the capital gains rates for those making over $1 million to 39.6% and maintain Section 199A, you end up with an end-to-end effective rate for corporations at about 56.5% versus the continued 31.7% effective tax rate for pass-throughs eligible for 199A deduction. This is roughly a 25% rate disparity. That is a major deal. That has tax making business decisions in a way that tax and the tax code were never intended to. Effectively, corporations are paying 2 years worth of tax for every 1 year that pass-throughs have. I mean, that is the kind of thing that is a major distortion, a major differentiator, and a major business driver, things that people are going to have to plan for. Ben, have you seen any planning activities out there that people should be considering for this kind of distortion?
I have, in fact. As you know, I went out to practice for a year after the TCJA was enacted, and in fact, the proliferation of crack and pack strategies related to 199 was quite extreme, and I think a lot of taxpayers took advantage, rightfully and lawfully, of what they could under the code. Section 199A provides an incentive for certain businesses, and I think taxpayers focused on the businesses that were intended to receive the benefit. And while you and I believe that the selection of those businesses may be a bit discriminatory and not have the policy support that we would normally associate with proper tax reform, they still exist, and they're clear just from a plain reading of the code. And so I think for partnerships to divide and separate their businesses did in fact occur, and I think the regulations that Treasury issued afterwards did their best to address some of those planning activities, but not entirely, and that's because it wasn't within their ability to do so, because the code does provide these types of benefits. And so obviously there were some transactions that required a heightened business purpose that may have been stopped by the regulations, but I think there are other transactions that were successfully done to take advantage of 199A.
No, I think you're exactly right. I mean, from my perspective, the goal of a tax system is to be as fair, transparent, and broad-based as possible in order to fund the needs of the country. There's nothing nefarious about tax. There's nothing negative inherently about taxes. Uh, but to the extent that distortions start to arise and become advantages for some and disadvantages for others, then the policy purpose behind and underlying tax and tax reform ultimately are no longer satisfied and they're no longer met. And that's where I think you end up with some negative outcomes and some negative results. But ultimately, I agree with you 100%, and I have for a long time now. So.
Well said, my friend. Jed, thank you so much for joining us today on Willis Weighs In. I greatly appreciated it. It was a great discussion.
My pleasure. Thank you so much for having me. It's always nice to talk to you and always good to see your face.
For those of you watching, please reach out with any questions or comments. You know, I like to talk about tax and debate, and I'd be interested in anything good or bad that you have to say. So feel free to reach out to me on Twitter at Willis Weighs In, or you can email me at ben.willis@taxanalyst.org.
Willis Weighs In.